All right. Good morning, everybody. We're gonna get jobs data today. Kind of a big deal. We're also going to get data uh, at 9:45. This is PMI, and then tomorrow we've got the VIX expiration. We've also got central bank rate decisions for various nations around the world, including Japan possibly hiking. So it's kind of a busy week. And OPEX on Friday, which is throwing a wrench in things like the market maker move so that we can't use it. Triple witching. Fun times. So this morning we have an opportunity for a liquidity gap play. This is one of my favorite um, timed event trades. We know where lightning can strike, and that kind of changes the game a little bit. I've gone over that trade many times in the past. We'll just kind of run it through here real quick. Um, if we get a big bar in any way, it will be useful. So if we end up with a big bar that looks like this is not the gap because there's really no gap. Price closed near where it opened, big wicks on each side. If we get a big bar like this, we want to just measure the whole bar and mark the midpoint on that bar and then use a projection of the entire measurement 50% in either direction, because that's what we do with ranges, right? If you've read any candle books, it'll tell you to measure the range and then project that range higher or lower by 50% and 100%. Well, anything can be a range, right? One single candle may not seem like a range to you, but what if I'm talking about a weekly candle and then we open that weekly candle up and we have 5 daily bars? Or we open that one daily bar up and we have 9 hourly bars, right? So just one candle can be a range. And once you kind of eliminate your own bias that one candle can't be a range, then you need to open your eyes to all kinds of possibilities. This one bar at 8:30 is very likely going to be a big bar. If it's wiki, like I'm showing in these pictures, then we just want to measure the whole thing, mark 50%, and project above or below, whichever way price goes, by 50% and 100%, because that's very likely where we're going to hit and pause or hit and reverse, which is what we would have if I had put the measurement on here. We paused at 50% and we reversed at 100% of this measured move. Same thing there and there. So it works, and it works really well. But what I'm kind of hoping for is the actual liquidity gap, which would be something that looks like this. So it's not a gap in price. You can see there's no gap here, but there is a liquidity gap. The idea is that it moved so far, so fast, that it didn't have time to develop any structure behind it and that we could retrace it. This particular one did not retrace. There's no wick going in the other direction, and it closed in the upper 25% of this bar. It did test the mid of that bar if we had measured out the midpoint, and it reversed at 50% of the bar. So measuring these bars is really helpful. This one never did return, but this one did. So no wick going in the other direction, closed in the upper 25%, paused at 50% on the way back, and it got the gap closed around 10:30 or 11 o'clock. By the way, I mean, just look at that. Isn't it so pretty? That's a fantastic reversal signal. It doesn't get much better than that. Same thing going in the other direction. No wick going the wrong way. Closed in the lower 25%. A little bit of a pause. rejected at the midpoint, got the gap closed before 11 o'clock, around 10:30, 11. That's generally the norm. So if you're thinking about trading it, consider the fact that you're going to be holding on to it until around 10:30 or 11 o'clock. I don't do it that way. This is what I call destination trading. I know where we're headed. The analogy would be you and your family are going to, I don't know, your family reunion, and you're taking different vehicles because you don't like those jerks and you want to be able to leave at any time. Well, you're both going to the same spot, but you're taking different vehicles and you're taking different routes because, of course, somebody doesn't like the one road that you take and somebody else thinks they got a faster route. You both get to the same spot, you just get there taking different paths. If this is where I think price is going, then I can get in and out of this as I see fit. I can counter trend trade if I want to. I could just get in and hold on with diamond hands if I want to. There's so many ways to trade it, but you know where it's going. There's a lot of trading books out there that says, you know, new traders, you could literally tell them exactly where price is going to be at the end of the day accurately, and they'll still screw it up and lose money. And I don't doubt that even one little bit. If you don't know what you're doing, then it doesn't matter how much you understand about where we're going on the day. So if this confuses you, just don't do it, right? It's simple enough. Keep your money. Otherwise, one of us traders is just going to take it from you. We always need market donors. So that's what we're looking for today. Gap close. We could have one at 8:30. We could have one at 9:45. Don't know about the 9:45, and we might not get one then, but you have these as a possibility all the time. They can happen at any time on any time frame, but it's nice to know when lightning's going to strike, and that at 8:30, it's very likely today that we're going to get one. You can see the markets don't like the uncertainty. Mostly red, a little bit of green out of Japan, up 0.5%. China's basically flat. The rest of the world's just on wait. We've got some projections on what the numbers could possibly be. It looks like the unemployment rate is creeping up from 4.4 to 4.5. That number very well may be in focus. And there's more analysts that are talking about how maybe bad news isn't good news after all. You know, when a company lays people off, the market has been rewarding them for it because they're cutting costs and, you know, trying to streamline. But at some point, those layoffs are no longer considered a positive, and the market will start to punish those companies rather than rewarding them. I can get the name of the analyst if it matters, but it's not just one that's saying it now. And that more and more analysts are starting to point out when we start to see these job announcements of layoffs, that we're not seeing the same sort of buy up potential that we used to see. And it all changes, right? It's a rotation, it's a cycle. When the market wants the bad news so that it can have an excuse to get the rate cut, then bad news is good news, and layoffs, although layoffs are bad, it's considered bad news being good news. And then the company who did the layoffs usually gets bid up until it doesn't. So as you can see, we're going to get a lot of data in 50 minutes, less than an hour. And then at 9:45 or 9:55, we're going to get that composite PMI. By the afternoon, we're pretty much done unless the Bank of Canada has something to say. Whatever. Yeah, eh? So Secretary of Treasury Scott Bessent is chipping his teeth this morning. It's not likely that he's going to say something that'll shake anything. Yeah, it's the Chamber of Commerce at Metropolitan Montreal. It's very likely not going to be anything of impact. And then we're going to see perhaps something coming out of the White House today. The president has a ceremony at 2 o'clock. If he gets a little Q&A, could start chipping his teeth, saying something that can shake the market. Otherwise, not really expecting anything, for the afternoon, right? Yeah, low risk. Low risk based on current schedule. All good. We could see things change once we get into the open. Mhm. The call wall and the put wall did not move, so it is still where it was yesterday. It's very likely not going to move, right? Until we get um, close enough to OPEX that they've rolled all their positions to a new spot, and that becomes the new call wall, put wall. With the VIX expiry tomorrow, I think that's going to be the final line in the sand, and they'll really start to roll. Because once they're changing the hedge on the options that they were running, then they can change the options that they were running, right? So change the hedge first, then change the structure so that you're never naked. Seen someone the other day said they had took off their hedge because they had every intention of putting a new hedge on the next day. And of course, what happened? We got whacked. It would have been the difference between these 2 days, right? Poor person. I get it though. That's what happens if you run without your hedge on. So we're moving back up towards the volatility trigger. We are under the 20 and the 10-day. We had a 310 surge signal yesterday. That's when price crosses under the 3 and the 10, and it goes so far down so fast that it brings the 3 through the 10 as well. And that's called a bear surge signal. It would be a bull surge signal if we flipped everything over. So when price comes back up through the 3 and the 10, we want to see it do that and accelerate above both high enough, far enough, fast enough that it brings the 3 back through the 10 on the other side. For now, though, we tagged that 50 period daily moving average last night, 68.32 cog line. You could see it down here. Gotta love those cog lines, and a nice 2-bar reversal. If you was trading last night, that was just absolutely beautiful. Gotta get it while the getting's good. So now we've tested it. The question is this going to be a bounce with a rally into resistance and then we roll over and we come back down and break it? Or is that structure and we hold? The last time we did this, right, we came down, we hit that 50 and we bounced up and set that lower high. And then we came down and broke it. Now we've managed to get above all of that, and we ended up setting that higher high. So it's possible we could be setting a higher low here. It is possible, especially because of this higher high, but looking a little janky. That's sketchy for sure. So don't be surprised if we get a rally today and we get some face ripper to the upside, maybe back up into 69.50, 69.75, something like that. if we don't set a higher high than this high, then the bounce up won't matter, right? It'll just be a bounce to get momentum for a break of that 50, and then we're really going to go. And that'll open up 67.50 and then 66.50, because that's just how we roll, yeah? Running 50s. There's the real mid of this move. 68.56. Nope, that ain't it. 69.11 cog line. Right there. All right, so don't let this bounce make you think that everything's bullish if we actually can hold the bounce today and run back up. On that last bounce, we got back up near where we opened, and that was just about all we got out of it. Now, so far, we've bounced and it's still red. So we could get through our own open and then get a little bit into the green, right? And so it could look a lot like this other one, but it doesn't have to. Either way, the candle is already formed. So unless we run back down today and we make this just a bearish candle, then we've already got our pin bar. Okay, ignore the market maker move, right? It doesn't help at this point. We already hit the lower ADR half. Since we hit it early enough in the day, that implies that we could go to the other side by the end of the day. That might sound bullish to you, but it's not. It's just a part of the way price moves, like a wave form, right? To go from this high to that low, we didn't do it in a straight line, right? We went down some, then we went up some, then we went down some more. So just because we're talking about hitting this upper ADR half doesn't mean anything about being bullish. It wouldn't even give us a higher high. It would just be a part of this wave, right? The red line that we see here, the one I've got marked out, that was the close today or last night. So getting back to the close is a good start. If we can get through that, we can aim for the other side. If we get it inside day breakout, then we've got 111 and 1236, which should get us up right into that 69.50 area. And if we can get through that, then we got the full ADR today, which would be a 1.25% move from the close last night, around 88 points. But we're going to get data in a few minutes. So we need to see how that plays out. And then we're going to get data at 9:45. Lots of things that can put a wrench in the plans. Today's floor pivot is lower than yesterday. That's bearish. Price opened underneath it, and that's also bearish. We haven't hit the pivot today, which makes it a little bullish because we kind of anticipate hitting that floor pivot more than missing it. It is a MDP only by tomorrow, right? On the question of when will I swap to the contract, this is Thinkorswim. Thinkorswim runs a continuous contract. So it's already running whatever it's supposed to run, right? See how it says active March. And like I mentioned yesterday, if your broker doesn't auto roll, then when the front option has less volume than the next expiry out, that's when you want to swap. So the December has less volume than March. It's time to swap. If you know what open interest is on futures and you know where to look, you could also swap when the open interest on the front gets lower than the open interest on the next expiry out. You could swap at that point. TradingView likes to do it on the Friday before. Thinkorswim likes to do it on the Monday of. So it really just depends on which continuous contract broker you're using. And if you're going to do it yourself, then that's what you would want to use, volume or open interest. The charts are going to be screwed up for about 3 days, at worst a week. And when we come in next week, you won't see that big 100-point gap that's on there, and everybody's charts will all look normal again. That gap will be gone, everything will be normalized, and it'll just be normal again. Until then, it's always a weird week, and it screws everybody up who's never seen it before. This won't count as a missed daily pivot until tomorrow. Would have to miss it all day today, then look back and say, oh, wow, hey, look, we didn't hit it. Until then, at any point today, we could hit it. It's not just a floor pivot today, it's a cog line today. 68.92 cog line. If we can get above that, we can start to focus on the S&R lines. And we are back above the weekly pivot. We need to keep it. We're bullish, generically speaking, when we're above the weekly, and we're bearish when we're below it. About those S&R lines, we were underneath S1, and then we managed to get back above it again. It took a while. It was quite a fight to finally get there, and then we buzzbeat off of it. And that should give us the structure to get back up to the top, and then perhaps get the breakout on Globex into a new Globex high a day. S1, R2, that is a thing. Now, it doesn't owe us that, but the textbooks have made it clear that it's common enough that they talked about it, right? So S1, R2. Of course, it could have been R1, S2. It doesn't matter. But we went down, so we're looking up. This is not about bullish and bearish. This is just wave form. Right? It's just what price does. So we could hit 69.60 today, and that still wouldn't be bullish on its own, because we would still be underneath last week's high, and that would mean we don't have a higher high on the daily as a level of mark, right? We're back up to the point of control, and you can see where all the structure is. The value area is a little bigger on the upside. I'm surprised it hasn't tightened up yet, but it will if we sit here and spin around at that 68.82 old school cog line. I don't validate that one anymore, but back in the day, there used to be an 82. If we can get through that and get a breakout on the value area, last week's point of control could give us some trouble. 69.11 cog line. Nice distribution last week. It really was. The value area low of last week is basically the top of this footprint that we've got to deal with. 68.92 cog line. So we're struggling with it. It could act a bit like a magnet, like it did earlier when we were there and hanging out. We're back here. We could hang out some more. So keep your eye on 92, because we'd have to get out of this footprint if we're really going to expand. Otherwise, we could wick out, come back in, and we could just reject off this point of control and head on back down again. That would be a nice wave form to the downside. $67.78 instead of $67.50. We've got a little bit of a speed bump that might slow us down into that $67.50. If we break 68.50, then get a new low, and 67.50 is on the table with that speed bump. All of these charts that I use are shared on my YouTube for this video. Next year, I'm going to be growing out my YouTube channel. So if you guys will help me out, go over, like, subscribe, right? Thumbs up on the video, help that channel grow. I've been running these things for years, and I've never really had any interest in growing that YouTube channel, but someone kind of put it to me as a little bit of a challenge, and yeah, I think they're right. It's time to get more eyeballs on these anyways, right? These morning briefings are pretty helpful, I think. And of course, you get access to all the charts, and I'll be building them out for TradingView for those of you who don't use Thinkorswim. They'll also be in the YouTube description, probably by the new year. 10-day, 30-minute volume profile and TPO. This is the nicest distribution we've seen for most of this year, right? It's just been a god-awful, ugly distribution all year, and this is really nice. But it also lines up with the clear structure overhead, 6907. Can't miss it. It's right there in our face. They line up well, the TPO and the volume profile. And if we can get through that zone, we still have to get completely out of the value area before it'll start to act as a resistance. So we got out of it down here. It's likely now that when we come back at it, it could resist us, and then we don't end up getting through it. So be careful of that. Just like it did here when we got outside of the value area and we came back at it, it was resistive. Of course, the longer we hang out there, then we can cross back and forth and it doesn't become a support or resistance. So see if we get through it. Then the value area, we're not expecting to see this point of control move anytime soon. We've got no candidates for a new location. Nothing. We got a new VPOC, which we're hitting right now. It looks like we just wicked into it. This is the point of control from yesterday carried forward. And you can see price just came right up and touched it. So technically it's not a VPOC anymore, but I would keep it all day today, or at least keep it until we've crossed through it. Now somebody's going to say, well, you already hit it back here. Yeah, it's true. It's not technically a VPOC because of that. We opened and we fell through it. So I'm not going to mark it as a VPOC, but it certainly is yesterday's POC. That is 100%. The textbooks would tell you to carry that forward every day anyways. And it looks like they were front running it. So they put in a lot of work right there. I'd say that that level is an area of interest that you really want to pay attention to. And that if we can get above it, get outside of this value area from yesterday for a chance to challenge yesterday's high. If we can't manage to do that, then there's just no run at the high of yesterday. It's basically 6,900 for the halfback, right? So if we can get through that lump, 6,900, then 6,911 cog line, 6,932, which is yesterday's high, and then game on to the upside. You got to love how those cog lines come into play over and over and over again. No help on the weekly expected move. Still didn't get a chance to draw out the new ones by hand. We are under the 10-day. So what we're looking for is kind of a slingshot move to where we get underneath a little bit, and then we come ripping back up the other way. There's plenty of examples of that in the past. These kind of moves where we go from a -3.5 to a +2 or 2.5 in a week. But we don't have it yet, right? We're still underneath it. We don't have any juice at this point, no momentum, inertia. And for the weekly, we are still above the 10-week, more than 1.25. Everything looks fine here. Between these two, we're still not overbought, overextended. We haven't moved too far, too fast, and it does not owe us any sort of pullback or mean reversion. That's really the number one thing I use this chart for, other than the weekly expected move, of course, is that distance from 10. It is the constant measure of that to ask, did we move too far? Are we going to pull back, mean revert, simply because of how far away we are from the 10? And right now the answer is nope. That's not really much of a surprise, though, right? Because we haven't really done anything. We've just been sitting in this range all this time. And other than a little peek outside the box, a little peek, that's it, right? We've just been holding the line. It's like Johnny Cash at this point. Walk the line, huh? So it's no surprise we haven't gone anywhere. This is an example of the liquidity gap that I was showing. That is a liquidity gap. And what did we do? We ran back up and got the gap closed. Of course, we managed to get above it too, but we made it there. A lot of times that's all you get, right? We actually overshot it a little bit, held and digested, and now we're above it. So we're looking for something like that, like that, like that. We still got another one, this old one back here. I would count that as a liquidity gap. Yesterday's RTH open. But we've got the opportunity for one of these to come today at 8:30. That's what we want to be focused on. Me personally, I'm not going to trade it as it happens. A lot of people that are new, they want to trade the news as it comes out because they have the expectation that price is going to make a big move. Well, you'll learn over the years that big moves also puts a big challenge on your stop. If you got to use that, then it's not worth it. Yeah, it will. Yeah, I'd rather trade when it's not so violent, so we don't have to use such big stops. Especially when it's just a guess on whether we're going to go up or down. You never know how those economic reports are going to turn out. Bad news could be bad news, or bad news could be good news, and vice versa. Good news can be good, good news can be bad. Sounds like a big coin toss to me. I like my money. I'm not tossing a coin. Looking at what's down today, we got energy, gold miners, bots, and energy again. Emerging markets is down, so that means China, but just barely. I mean, it's just right on the line, half. Quantum's weak. Uranium kind of ties in there. Both weak, but not down enough yet. And looking at what's up this morning, we got Bitcoin and Bitcoin. That's and VIX. Now VIX is up 7% in a 5-day period. Bitcoin was down 9% in a 5-day period. It's now up 1.5-ish, but still down 7.5 over a 5-day period. Same with the ARC stuff. So not really looking for bonds to help us out, right? If we're looking for a rally day and we're asking, what sector or industry or group is going to get that done and push us higher or lower, this ain't it. So on the downside, if we were looking for a bearish move, we don't have the bearish triggers. Now the mags are down 0.25%, but I don't see that as necessarily negative. I like a little pullback before the next run up. It's kind of a good thing to me. Silver being down more than 1.5, that's a bit of a kick in the face. but silver has been just on a complete tear and it needs it, right? I mean, look at that move. First this one, and then all that digestion. Now this one, it's got to take a break, right? So, at least it's healthy to see that. The China stuff, I mean, it really looks like we're going to get another leg lower there. Really beautiful price action, nice and clean. So Baba, Baidu, JD, PDD, XPEV, Neo, all those guys, right? EDU. Gold got that 111 or 1236 and then just took the smackdown again. But it's higher lows. So we want to see if this turns into a higher low or if we're going to break the mid here and come down and break this low and set a new low. So far, gold is working exactly like a measured move should. I mean, this is really beautiful stuff. Like pinup posters for price action. Pot stocks getting a little bit of a reversion after that big move. So we don't have the catalyst for a downside looking at what is down this morning, but we don't have a catalyst for the upside either. You don't want a rally day on pot stocks and Bitcoin. It's just not going to get it done. Plus, why the discrepancy? We got some pot stocks down, but the pot stock ETF is up. It sounds a little janky to me. So even the industry itself doesn't know what it wants to do. Still, if we're looking for a rally day, we want Mag 7, consumer discretionary, tech, financials, and we don't have them in force. We got a tiny little bit of financials and not the good one either. This is the generic XLF. We'd want banks, right? KRE. We just don't have anything yet. So until we do, the call is sideways. Something has to pick up and give us that push. And that can come from headlines. It certainly can. We could get headlines this morning, and then we could get 0-day flows once the day opens. And then we wouldn't need those Mag 7s or the sectors or anything else, right? That would get it done all on its own. But there was some moves in the 10-year. The 10-2 spread got really wide. It's now wider than it's been since 2022. So it's that steepener on the yield curve. Then Japan is scaring everybody. So, I'm not discounting bonds and yields and their impact. But the jobs number and the inflation data is going to come first. And then the market will look, further out from there. So we got to get through the 830 print and then the 945 print. The levels are clear. Get above yesterday's high for a chance to challenge last week's high, that 69.50 and then above into that 7,000 and then 70.50. But if we break this low 68.32 cog line, it's game on to the downside. We'll get back underneath that 50 and we'll start working on the half back of this whole range, whether you're measuring it this way or you measure it that way. Because if you look at that, they're only 4 points apart. So it doesn't matter which one of those you want to use. I'm going to use the original. So topping out back here down to this low and then the run back up. So 6,800, basically 67.95, doesn't matter. That'll be the next stopping point once we get through that halfback, 68.32, 50 period daily moving average, then the half. Then 67.50, the roundy on down to 65.81 or 66.50, 6,600, because we're still running 50s. 50s. Simple enough. Obviously, all not in a single day, right? Don't get me wrong, price can do it. It's just not likely to do it. All right, so that's what I got for you guys. Be careful, be safe, keep your eye on the clock, and remember that big bar that we get at 8:30, whether it goes up or down, price does not have to keep moving in that direction, and it's very likely it'll mean reverse and go back to where that big bar started. That's the liquidity gap play in a nutshell. You can trade it any way you want or not trade it at all and just use it for your analysis. That's the safest thing to do, especially if you're just learning it. Draw it out, mark it, get used to it. Don't risk any money on it if you don't understand it. I'll see y'all tomorrow.